Are we in a growth phase or are we in a slowdown? Are we actually able to adapt to the COVID shock and continue to grow or not?
The most important message here is that growth has occurred in 86% of all months since World War II. The economy grows because we invent technologies and we find better ways to get things done. So you can take a look at how the trend for output per hour is really powerfully up over time. Or the trend in the population growth rate, right? The number of people who can take that technology and apply it in their lives and produce and consume more is on an uptrend. So the point is that growth is very natural.
We're going to be in a period of slower growth, but we're not going to be in a period of growth that gives us any cause for concern. And so for us, a moderation of EPS gains over the next 2 years is by definition inevitable. But the probability that we're going to have a shock or a decline in earnings is highly unlikely.
When I think about what 5% EPS growth could mean, when I have a 2 to 4% dividend, and then I think about 1% global bond market with no decline, just less up, I start to think about saying, well, why am I getting out of equities? And we aren't, right? We're taking steps, and this is not what this presentation is really about, but to invest in those sustainable areas of the equity market, like healthcare, like technology that we'll talk about, that have very convincing growth rates that last, that are not just bouncing back from a depressed period of time.
Longevity, in terms of healthcare, is one of our unstoppable trends. And obviously digitization, hyperconnectivity, the whole idea of cybersecurity are all three others of our unstoppable trends. These types of trends are things that have to be in your portfolio when you're going to hold for 3 to 5 years in order to add alpha and to actually outgrow indices. And they're areas that we think have sustainable growth stories behind them.
The consumer story of the world is Asia. That is really where a lot of the world's growth will come from. And one way or the other, whether you invest in China directly or you don't invest in China directly, it's going to have a lot of influence on your portfolio through indirect effects.
When you take a look at the average 10-year return data, you'll see that small caps, US equities, and world equities have actually done just slightly better than an asset allocation portfolio. But in a situation when you're in a low interest rate environment for a sustained period of time, we believe the probability that equities will outperform for the next 5 and 10 years is considerable relative to bonds.
I think people are getting tired of markets having very large gains. We don't expect large gains, but it's just difficult to see that we're going to put together a sustained decline in equity returns if the economy has years of growth ahead. So we're above consensus for 2022. We'll be a little bit below consensus for 2023 on EPS, but the levels of profits that analysts are predicting are really the right levels. The bottom line here is we're in an environment where absolute returns are positive, but they're going to be lower. But I think less up for me is not a new down.